Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. As always, sorry I'm late, but like am I having data issues or something? Because like nothing is moving. I think I'm having data issues. I'm going to shut everything down and restart it. PayPal says yes, data issue. Because you're not, you know, because you were just fine, right? You didn't even restart it. When I turned things on, I was like, is there a holiday I missed or something? No, that can't be right. Because it's supposed to be non-farms today and it's delayed, right? We're not going to get it, I guess. No, it's definitely Rhythmic because Rhythmic here is crashing. I went to shut it down and it is not shutting down. Book has less liquidity. Well, let me just come over here to the camera while I'm fixing it. He says it's a bit thin in the treasuries too, not terribly so, but noticeably. Interesting. Oh. Rhythmic updated to the latest version. Maybe that's why. Okay. Looks like that fixed things. Let's just give it a few minutes. I'll load everything up. We do have the Fed's Goolsby speaking at the moment, so that could move the markets. Or maybe explain why the liquidity is a little light. It is, I am noticing here, I don't know, is it better than when you said that, or is this what you were talking about? Because we are seeing like 4,000s instead of like 5s and 6s. So it does kind of seem to me like some players have left the market, which I don't know. I mean, I think that we still got ISM services PMI. I think that should be a pretty significant piece of news. So, but that will mean we'll probably be relatively range bound and quiet. Let's come in and check the charts. A couple of things I want to talk about. But first, let's just go through, what we got. I don't think that there was anything too significant overnight. You can see here, yesterday, Treasuries down and up. This morning, it looks like we had a little bit of a down move, but it was only a few ticks and we're mostly unchanged. And there's maybe a little bit of noise here, but it doesn't look like they've picked a clear direction yet. S&P 500 taking a pretty big dip yesterday at the beginning of this session, but recovering it quite well. And we're higher now in the overnight session. Oil actually dipping below 61. So that's interesting. I might need to go to a higher time frame here. Like, how big of a deal is that? I'm not sure. This is a little bit concerning, actually. Interestingly enough, the moving averages are all a mess. So that kind of has me, might be iffy still. I don't think the momentum players are coming in here in oil. Gold and silver took a little bit of a hit yesterday, but well, they're taking it in stride. It just seems like nothing can stop gold and silver right now. Copper continues to rise here. They're looking pretty good. And then the Japanese yen was on a 3-day winning streak, has moderated a little bit. Yesterday, there was a point yesterday where we saw a pretty strong move in the dollar. But, like, overall, it wasn't that big of a move relative to the most recent action. And Bitcoin continues to go up again. This move, you take the whole thing, seems starting to look a little bit unnatural, don't you think? To come over to Bitcoin, have we had a rise that quick, that fast? Well, this one was, and I think that this one back in July, wasn't that driven by Michael Saylor buying? I'm not sure. Okay. So something weird that's been going on, though, that I want to point out, because we were talking about, Uzi was showing me yesterday, like, okay, they did come back, because we were wondering, like where would it get to? Would they get back to the 113 even or above? Well, they didn't quite get back to even, but they did come back to unchanged. And it was just kind of like, wow, that's so wild, because it usually doesn't do the V sort of thing, But like, it's been happening a lot. Here's this session. I don't know. That one doesn't count. But here's this session. I guess you could kind of consider this one the same thing, but the other way, right? Like it's been since this big move down. Let's scroll out a little bit. Well, and here's another one. Oh, actually, that one doesn't count. I'm looking at the wrong line. I'm looking for the blue line because that's where our session is. This is one. This is one. You could maybe consider this one, but this looks like that was news that was quickly retraced. So it's just been doing that seemingly a lot, which is like, I think a little odd. This sort of a thing right here, but like smaller, is I think more typical for treasuries. So they kind of pick a direction and then they just settle where they were at. So these like retracements seem a little unusual to me. Because it feels like that we've or at least Uzi has predicted like these retracements. But I don't think technically that's what's happened actually, because really what's going on is he's saying, well, this is as far as it's going to go. And then if you took a trade there based on like a fair risk reward, it ends up coming back up to it. But wasn't necessarily predicting it as a complete retracement, you know? So that is all just, to me, incredibly interesting. Well, let's turn the robot on. I think that the robot is likely to trade really poorly today. Maybe we should just start, you know, doing this on our own. Like, okay, I think that it's a tighter day. That means that the imbalance needs to be larger to trigger. Man. Okay, so let me see if we can get more information about non-farms. Goldman client survey finds AI FOMO off the charts in year-end performance panic. Oh, that's interesting. Okay, so here's something that I think about often, but I haven't talked about with you guys very often. What is a bubble? Right? Like, we have this conception of a bubble, that a bubble is when the prices have gotten too far ahead of fair value, right? But then if we come back and we look at the order flow driven theory of markets, when we realize that prices are almost never correlated with fair value. Like, the market tries to be, maybe partially because we all have this idea that it is, but the reality is that it's very imperfect about it. And so from that perspective, who are we really to say that something is overvalued or undervalued? And like, when something becomes overvalued, because what's actually happening? People are putting money into it. The markets are inelastic, and those impacts are permanent. It's like if you have a rubber band between your fingers and you pull your fingers apart, the rubber band pulls them back together. But if it's inelastic, then the rubber band just stretches, and then they just stay where they are. The price impacts are permanent, right? So there's this idea, like the value investing, right? When we get too far ahead of value, then I should sell it. Or when we're too low below value, I should buy it. And that is a valid strategy, and is a strategy that can work. But the asset managers that trade fair value have not been doing that well in the modern era, right? In the modern era, there's so much liquidity floating around in markets. You know, maybe I would have thought in the last year, or last 2 years with high interest rates and everything, that would have turned around, and that value players would have made more money. But that hasn't really been the case. So then you have to ask, well, are there instances where, like, something becomes overvalued and it doesn't come back? It doesn't come back? And I'm not familiar with the specific ones, but my understanding is actually that there are. And that what happens is people put so much money into the company that it allows that company to develop in ways that it wouldn't be able to. And so it's almost like a self-fulfilling prophecy, right? Like, they're putting the money into it, and the money finds a way to find a return, you know? And I wonder if that's maybe what's going on right now. Like, with the AI, there was a study out the other day basically saying that there's no evidence that AI is replacing jobs. But there's a lot of spend in AI. It's like single-handedly propping up the economy. And I'm not sure if that has to change. It's like, you know, what if what if it really is just like the economy all shifts to everybody supporting AI? You're either building the AIs, training the AIs, or getting the materials to make the AIs. You know, like, yeah, Feds Goolsby says we are seeing both sides of the Fed's mandate deteriorate, which isn't really too different from what they've been saying, right? I don't know. I don't agree with that, though. I would say that we are seeing both sides of the Fed's mandate at risk, not necessarily deteriorating. Because are we really seeing inflation deteriorating? I think that what we're seeing is inflation has stabilized at a slightly higher rate than we want, right? Let's come back and look at that. Let's see here. Let's look on Fred. Fred, inflation rate. How about this one? I don't think that one is granular enough. Okay, here's core CPI. Oh, wait, why would you want that one? You know what? Let's just go and look at it on Forex Bank. Non-inflation. Yeah, let's just look at CPI year over year. Right? Okay, so here, inflation was really bad, right? So it's stabilized. Now, interesting, you see this little kind of wave thing? So there are cyclical and non-cyclical components of inflation. So through the middle of 2024 and beginning of 2025, we were kind of seeing a section where the cyclical components were going up. And now we're back into another era where the cyclical components are going up, right? So be careful about that. That doesn't mean that like, oh, now it's going to go whoop. No, probably not. Probably what's going to happen is this is going to do this. But problem is that it's doing that between 2.5 and 3%, and we want it to be doing it more down here. We want to be doing it more down here. So it's I wouldn't say that it is deteriorating. It's just it's normalized at a slightly higher level than we want. And I don't know what the mechanisms of this would be, but it kind of seems to me that with all of the things that we just did, all of the debt that we took out and the impacts from COVID is really pulling the economy really quick one way, and then you're going to see, knockoff effects after that. I would think that you would have inflation be higher than you want for a long time, regardless of what you do with interest rates, unless you had a recession. Because honestly, like, when have we had situations where this has happened and we raised rates so substantially and we didn't get a recession? I think it's only happened one other time in economic history. Like, we don't have much to compare to. And I think that our financial system has changed so much after 2008, and it's so much more stable that maybe that's just more likely to happen than it was before, simply because the system's more stable. You know? So then what do you do when you don't actually get a recession? Maybe the answer is that you have to accept slightly higher than usual inflation. That, you know, it comes back to 3% instead of 2%, and you just kind of have to go, oh well. Otherwise, like, how else are they going to deflate away the public debt, right? Like, if we don't have a slightly higher, you know, a 3% instead of 2%, if we don't get that, is it even possible to reduce and deal with our debt situation right now? You know? I don't think you would ever catch up. So that's kind of why I think maybe there's some mechanisms at play there that kind of make the inflation slightly higher than you would like. And it has nothing to do with Fed policy, you know? So I don't see that as a reason. Like, I think some people think, well, we're at 3%, not 2%. That means that we need to raise interest rates, not cut them. I don't think that that's correct. I think that we are seeing the labor market deteriorating. We're seeing inflation not necessarily where we want it to be. So that says to me that the more important thing right now is still the labor market. And, you know, I don't think that that's how the Federal Reserve came to this conclusion about that we need to cut interest rates, but it's maybe a different way of arriving at it. Right. Really, you have to deal with, if the labor market thing gets bad enough, you really have to deal with it, because otherwise you'll get deflation. And that's really, really bad, right? So I think that's where the Fed comes from, is they look at that and well, this is concerning enough that we're going to stop the other stuff. Just we have to. Yeah. Well, I would say for the first 30 minutes, this has been really quiet. In fact, maybe the most quiet this week. Trying to think, there was a day last week that was really bad, wasn't it? Was it last week? No, I think it was a few weeks back, like the 19th. Yeah, last Thursday. Some of these days, actually, I'm going back and looking at it on my other screen. The Treasury has been tight. Wait, where's my daily? Yeah. Oh, that's the wrong one. That's the S&P 500. I want the Treasury. When you look at the volatility of this, okay, like we're underperforming volatility a lot lately. You know, Uzi, that's what it's got to be. Is just we are in a period where we're underperforming volatility, and so when that happens, the play is to sell the options, and the play is it gets to the extremes based on the implied volatility from the front, the at the money contracts. You'll get to those and you'll reverse back to unchanged. And I don't think that that's going to be like a usual play, but it is in these markets. So it was like I was talking about yesterday, like, you know, you have Play-Doh in your hand and you squeeze, and then the Play-Doh just squishes out between your fingers. there's always these variables that you can't control for, right? And the big one here is volatility. And right now, because volatility, we're underperforming volatility, it behaves one way. And then when you get into a market where we're outperforming volatility, it will perform another way. But you can actually predict volatility relatively well. There's some of these Garch models and things like that. We know that volatility is partially path dependent, things like that. We can improve our estimates of volatility, right? And then trade our algos based on that. And I think at least in this period, we had an algo that was really basing things off of that. I think it would probably be doing okay. Just okay, because these aren't huge moves, but it would be doing just okay, right? Joe Rogan rages at media silence on UK's Orwellian nightmare. Oh, totally. Dude, it was really wild. I've avoided talking about this, but like when they took Jimmy Kimmel off the air, the amount of media and stuff that I saw about that was really wild. And I kind of even forgot about the stuff that's going on in the UK, but Joe Rogan is totally right. It's like they're like literally arresting people just for expressing opinions in the UK, and nobody says squat. I don't know, man. Coming to us soon, says Apol. I hope not. Like it's a difficult thing because it's really important that we have free speech. It is. But I also think that there is a lot of internet conversation that happens out there that is having an objectively negative impact on the world. Like there are people that are dying that would not have died otherwise if it were not for people online saying crazy stuff. And I don't know how you deal with that. Like, I think that in the past...
Order canceled.
Yeah, you have free speech, but there are kind of self-policing controls on that free speech in the real world. When the people you're talking to are like right there, right? Things that we don't have online. So on TikTok, supposedly you have like an audience bucket. Like when you post something, it goes out to this bucket of users based on common interests and all of these sorts of things. And then they say, okay, if it does well with that initial bucket of people, then that means that we can show it to the wider audience, right? And then that's how it just gets bigger and bigger and bigger until it gets shown to everybody, and that's when you get like viral video, right? I rubbed my eye because it was itching, and I'm regretting it now because it's making the edge of the contact is sometimes itching something will make it worse. I think I made it worse. Anyway, so I need to not touch it. So my thinking is that the problem with social media is that you're putting everybody out there to view everything. That if I go on Reddit and I post a comment, everybody sees it. And then it becomes this like popularity war where if there's like a 50-50 issue, right? 50% of people will upvote it and 50% of people will downvote it. And just like that slight difference in popularity will result in the comment that So it almost becomes like a tyranny of the majority sort of a thing, right? But what if the social network was kind of more like what TikTok does, except for that it's visible to us. You post, you have your bucket, and you know the people in your bucket. You know who the other people that are creating content in your bucket are, and the people that are commenting on them, because it's like the same 200 people, right? And then your bucket is part of a larger bucket, and right. The problem is, not everybody's online all the time, right? Like, you can get away with that kind of structure in the real world because, like, we all have to be physically present anyways, right? But online, what if you get put into a bucket and then all of the other users in your bucket stop using the application, right? So then you can't really create a stable community like that. That's the fundamental problem. Let's ask ChatGPT about this. Let's ask ChatGPT about this. I'm gonna bet you that ChatGPT doesn't have any good ideas about this, but we'll see. Maybe people have talked about. Maybe there is some discussion or scholarly discussion about this online, and how would it deal with this? Okay, person belongs to several parallel communities. Encourage rituals, weekly polls, events, or challenges to keep activity predictable. Now, that's the one method I've seen that works really, really well. But in those cases, the ritual was to get together to play a game. I guess we have our daily ritual here, don't we? Well, I should think about that. So we did have a little bit of a move down. Kind of looks to me like the robot didn't take it until it was already moved way too far. So it's not going to catch a very good spot. You know, I wonder, is there a way that we could say, okay, so we have the imbalance, the market order imbalance, right? You know, when it starts moving down, it's already moved too far, so it gets in too late. And what we need to be able to say is, you know, it's been flat for a while. Now I want to get in where it's flat. So what are some ways that I could deal with that? Like, could I find some sort of a... Well, if you were looking for a divergence between the market order imbalance and the price, I don't think that that would work very well, because then that would make you take trades in situations where the order flow is not dominant. So I think that would be unlikely to work very well. We could do things like a roofing filter. $24.5 to $25 is a spot. Oh, okay. That's interesting, just because I feel like we barely moved, you know? We barely moved and we're already to a spot, I guess. Well, but there was the overnight, right? And the session kind of opened near the highs. I should note, just, you know, coming over to correlations and stuff. Okay. Not really anything happening in the spreads. The selling did seem to be more in the 10-year than in the other
Order
instruments.
canceled.
I'm not really seeing a correlation with the Japanese yen. I mean, I guess there was probably that big bar right there. Let's see. Yeah, that big down bar in the yen does correlate. But it's not like a new low. There's not like a trend in the Japanese yen. Meanwhile, gold is moving up. Gold is moving up. I think that this is consistent with the flows that I would expect to be seeing coming off of Goolsby's comments. Like, both sides of the mandate are at risk, yada, yada, yada. That, you know, the way that he's saying it might be kind of more, oh, you know, maybe they're not going to cut rates. Right? Actually, let's come and look at that. By the way, I don't know about this Goolsby folk. You know, I don't think that I know enough about him to really criticize him or anything. But it just didn't it seem like that a couple of months ago, especially when Biden was president, that Goolsby was just like endlessly, nauseatingly dovish all the time. And now all of a sudden he's kind of turning into a little bit of a hawk. Like what? That's kind of hard to square away, in my opinion. All right, Fed Watch. The next meeting is in 26 days. I mean, that's not that far away. So the current rate is 4 to 4.25. And they're saying with an almost 96% probability that they will cut in October. How come the December one is... oh, just because it's the last one this year, probably. Oh, really? 4 to 4.25 is the current rate. And that's one cut, and that's two cuts. So they're actually... the market is actually pricing an 86% chance of 3 cuts this year. Two more cuts after this. Oh, sorry. Let me pull you over to the right screen. That's December. The market is pricing that they cut in December. And only a 12% chance that there's only one cut. What about January? Or maybe I should go to March. That's 1, 2, 3. They don't think that it will be beyond that. Although that's interesting because when you get to January, then they think that there's only a 54% chance of 2 cuts. Huh. And the March 325, 350. Huh. So then by March, they say, for sure, there'll have been 3. FedWatch is kind of saying some interesting things. But I've seen this on Zero Hedge where they're like, you know, when the chance of cuts this year goes down, the chance of cuts next year goes up. So not quite sure what to make of that. Very interesting. Initial jobless claims ticked up last week according to Goldman's model. Okay. Oh, man. And we're totally, you know, it's kind of funny. I don't really feel like people are paying too much attention to the government shutdown. Because I remember that first time that I saw government shutdown back in like 2013, 2015, whenever it was, under Obama. It must have been 2013. Like there was so much focus on that. And it really, really hurt Republicans because everybody blamed it on the Republicans. And this time around, it feels like nobody cares. Which to me is weird because I'm concerned that there's going to be some real collateral damage from this. I'm concerned that this is going to go on for a long time and that there's going to be real economic damage. So people should be paying attention, but they probably won't. Hold on, I'll be right back. I'm going to go check on something. Apple says it's not that important. We've seen this play before, and the shutdown means almost nothing. Well, so one, I think that there are negative impacts from a shutdown, but you know, they're kind of like they're mild and it ends up being a wash. At least the past ones. I think that with Donald Trump threatening to permanently fire mass numbers of government workers, that's going to have a pretty negative government or economic consequence. But I also think that the dynamics of this shutdown are different. In the past, I think that Republicans genuinely believed that the shutdown would give them some leverage to be able to extract concessions from. And basically what happened was the Democrats said, we can't budge hardly anything, because if we do, that will reward it, and then they'll use the shutdown all the time to get what they want. I don't think that that's what the Democrats are doing. Because just when you look at like what they're asking for and the way that they're going about doing this, it really feels more like that the far left of the party really want to have a showdown with Donald Trump. That's what it's really about. And so I think that with a shutdown, since there's not really any, I don't think that there's any agreement that they can possibly come to that will shut it down. It will really come down to who's willing to experience the most pain. Because I tell you what, on the Republican side, not a single Republican can vote on a bill that gets rid of the restrictions against Medicare funds going to illegal immigrants. They cannot. They will not vote on that, no matter what. They'll allow the government to be shut down for the entire rest of Donald Trump's term if they have to. They will not vote yes for that. No, they're not a chance. Right? So if Democrats are asking for that and they're not going to take it out, which kind of, it seems like that they're not going to take it out, you know, then it'll just be like, how bad can things get before they'll take that out? And that's why, you know, like, I guess it's not like you're important that you pay attention to it right now or anything. But I think there is, you know, it could get bad. I just think that the dynamics of this are a little bit different, so it leads to more likely to lead to a scenario that's really bad. You know, on the past shutdowns, when we started to get to these things where like, okay, well, it's been this long, and now when it's been another week more, then we're really in trouble, and they're not willing to jump over the brink on those, you know? Apal says, Americans can't afford health care, but boy, oh boy, they'll shut down the government to make sure illegals have it. And they act like including millions of illegals will make it free somehow. Well, okay, so the provision in the reconciliation bill that the Democrats want struck includes more than just the prohibition against illegal immigrants having healthcare. That provision overall is there to reduce costs to government. Right. So there are, my understanding at least is that there are provisions in there that make healthcare cheaper for certain people that are not illegal immigrants. Okay. But I don't really, I think because some Democrats are making the argument that like, oh no, we just want people to be able to afford healthcare. That's why we're shutting the government down, right? That's like kind of the cope. And it's like, okay, then why doesn't the bill that you're pushing just replace that language and say, okay, we got rid of this, this, and this, but we're still keeping the thing that prevents illegal immigrants from getting paid by Medicare, right? If they were actually serious, that's what they would do. I haven't seen that yet, so. I have to look at both sides of it. I was thinking about it yesterday because that one video, yeah, it got like 1,000 views. It did okay. Did better than some of the other TikTok videos lately. Some of the comments on that were a little bit jarring to me. Like there was a lot of people that are like, no, that's a lie. No, it's 100% true. And it's pretty clear, straight reading of the bill that says that. Okay. So there are some people that are just in complete denial. They're still in the denial phase of it, right? They're still in the denial phase of that. And it's funny because I feel like I'm making the Democrats' argument for them because the Democrats didn't really make it very well. You know? Isn't that weird? We did get a couple of clicks there, and there are some icebergs on the offer, but it looks like they are able to tick up. Here's an interesting headline. The economy is just getting stronger, not weaker, and we in the economics profession need to look at ourselves in the mirror. From Yahoo Finance. One of Wall Street's most closely watched voices delivered a blunt message to peers and policymakers. The U.S. economy is not faltering, it is accelerating, Torsten Slok, chief economist at Apollo Global Management, said. Forecasts of an imminent slowdown have repeatedly been wrong. And the economics profession should start grappling with its track record of misjudgments. You know, I think that even with me, I have been concerned at many points about slowdown. Not like predicting it, but like being a little bit cautious myself, and then it never happens. The consensus has been wrong since January, Slok said in a note circulated to clients Wednesday morning, adding that the average of economists' forecasts has said that the economy would slow down for 9 months running, but the reality is that it has simply not happened. We in the economics profession need to look ourselves in the mirror. Yeah. Like there were some people who were predicting real doom. I kind of thought, well, the predictions are that things will slow down a little bit. And I think you could say that things did slow down, like briefly, but it was like in certain areas, and the overall economy grew, which goes back to the thing I was talking about earlier, which is I wonder if it's just AI spend is propping everything up. You know, like if it wasn't for AI, maybe we would be in a recession, you know? But then there's the whole thing that like maybe there's not any actual value to be pulled out from AI, and so this is going to collapse. And hard. The Atlanta Fed's GDP Now model suggests growth may be even stronger in the third quarter, forecasting 3.9% gains. Many economists had expected the lagging impact of high interest rates, tighter credit conditions, and April's Liberation Day market shock to drag growth meaningfully lower by now. Instead, the data tells a different story. Consumer spending has continued to prove resilient, and business investment, far from retreating, has strengthened in sectors tied to artificial intelligence, energy, infrastructure, and manufacturing offshoring. Housing, often sensitive to interest rates, has shown surprising stability in key regional markets. Slock did not dive into these particulars in Wednesday's edition, except to address slowing job growth. This is the result of slowing immigration, he wrote, not economic weakness. I disagree. Like, okay. Like the overall job market numbers, maybe it is because of slowing immigration. But that's not why everybody in tech is having a hard time finding a job, okay? Here comes the S&P 500 open. Bottom line is that the U.S. economy remains remarkably resilient. It is becoming increasingly difficult to argue that we are still waiting for the delayed negative effects of what happened 6 months ago, referring to President Trump's Liberation Day and the imposition of sweeping reciprocal tariffs. One top-end analyst has been arguing for years that most of Wall Street was wrong and that Liberation Day represented the end of the beginning, rather than the beginning of the end. That's weird. Steam is telling me about an autumn sale. Okay. Rolling recovery underway. Mike Wilson has coined a phrase to describe what's happening in the economy for roughly 3 years, a rolling recession. The economy has been quietly weathering recession-like conditions since sometime in 2022. Wilson has argued throughout with a recession not being picked up by conventional measurements, but rather rolling through different segments of the economy one at a time. Wilson contends headline figures such as GDP and unemployment missed serious underlying struggles, including an 80% collapse in hiring over the summer and persistently negative median earnings growth. Neither he nor Slack has noted how their readings of the economy intersect. Wilson believes the economy bottomed out last spring, coinciding with the White House's Liberation Day crackdown on tariffs. Federal unemployment was one area not affected by the rolling recession, he noted, until Elon Musk's Dodge initiative remedied that rather dramatically. In early September, Wilson argued the weak jobs report for August had just been issued, provided further evidence of our thesis that we are now transitioning from a rolling recession to a rolling recovery. In short, we're entering an early cycle environment, and the Fed cutting rates will be key to the next leg of the new bull market that began in April. The jobs report for September is not yet out at this time of publication. But on Wednesday, the private payroll report from ADP showed a loss. But I don't know. This is just kind of going on now. I wanted to see the part where he says we need to look at ourselves. I didn't get it. Okay, whatever. And stuff. Good morning. How are you? We have been stuck at 27 for a bit. By the way, there was a brief drop in gold there that is a little sus. S&P 500 initial action has been positive. You know what? I came over. I totally lost track of what I was doing. If we're not getting the non-farms, do we know when we will get it? The monthly jobs report, along with other closely watched economic data, won't get collected or reported during the shutdown. Oh. Shutdown could also delay the release of September's inflation data, set to be announced on October 15th. It's funny, this article is talking about, well, there's some data in November too, but like, seriously, what if it's not until next year that they resolve the government shutdown? And it's kind of curious because it seems like that the treasuries are getting less volatile. It's like without that economic data, they're not a reason for them to move or change. It's a little concerning, isn't it? I think that's a little concerning. What do you mean market's simply having a childish tantrum on the ground right now since Big Brother didn't give happy news? I mean, the S&P 500 has been up. I feel like that the treasuries haven't really moved all that much this week. Now, on the S&P 500 side, they're starting to approach the overnight high, 6787. Let's see if they break out to new high or not. I'm a little... Oh, hold on. Still at 2070. You know, I probably should have recentered there. So, I come over and look at the chart. So often they will just rotate in over a 3-tick range, which is really like there's the middle and they're able to cross back and forth across that middle. But they haven't even been able to do that. They're not even crossing. It's just there's liquidity at 26.5 and there's liquidity at 27, and they're just trading between that. And it's been like that now for well over 15 minutes. That is tight. That is a tight market. It's a little disconcerting to me. Okay, so we did just get the S&P Services PMI final, which was slightly higher than expected at 54.2 versus 53.9, and the composite turns out to be 53.9 versus the expected 53.6. But remember that at the top of the hour, we get an ISM Services PMI. What the heck? Pope Leo the 14th is receiving backlash for blessing a literal block of ice at a climate conference. Are you kidding me? What? Oh, there it is. There's a picture. There's a picture of the Pope blessing a block of ice. Okay. Well, we did finally tick down. By the way, look at the liquidity there on the offer. That's a little suspicious. Whoop. These guys are okay. They're like, well, of course, if we break the range, I'm going to take it. I know it's really itching this morning. Linus Torvald vents over completely crazy Rust format checking? Real? In response to the recently submitted Direct Rendering Manager subsystem pull request, Torvalds began by voicing his displeasure over the text formatting of it. Doesn't Rust have a built-in formatter? Then I see. When I run Rust format check, that thing is all bass backwards. Bass backwards garbage instead of making it clean and clear to add new rules. This is just annoying. Yeah, I don't like that either. They should change that. Hey, Rust, you should change that. Okay, well, we're down at the lows now. What did you say earlier, Uzi? 24 half? Yes, 24 half. So they could touch it. So a little curious they're doing that now instead of waiting for the 8 o'clock news. 10 o'clock if you're in the Eastern time zone. There's 122 comments on the Rust thread. They're all saying I think he's right. Yeah. If 24.5 breaks in ZN, then the next step is 19. I think it sure would be interesting if we got to the 10 o'clock news and we were right at 24.5 for the news, right? And then if it were to break, that could be pretty devastating. Years chilling just outside the range. Well, so here's something I also wonder. At least on the down move. Well, you know, that's actually, it's really weird to come in and look at the cumulative deltas. Okay, so like on the down move, here's the down move. Here's the down move. Let me do this. 9. So here's the down move. Here's the down move. And right, the down move. It looks to me like there was more volume in the 10-year. But then since then, it's actually been a net buy. It's actually been a net buy. So I'm thinking that in this situation, that number one, that the 10-year appears to be dominant today. The 10-year appears to be dominant today. And two, if we get a breach of 24.5, we have trap traders. Yeah. But I think it'd be very doubtful for us to breach that level before the 10 o'clock news. So it might be we get the 10 o'clock news. Maybe it's really good. Let's see, what are we looking for? ISM services PMI, looking for a reading of 51.7 with a previous reading of 52. So if we were to get something like 52 or higher, that would cause the treasuries to break. And then if they did, they might break quite measurably. And Uzi says that the downside target is 19. Well, that was an interesting downtick, wouldn't you say? Still didn't breach the low. But it did seem like a forceful downtick.
Order cancelled.
Curious if the news is going to yield much movement since volatility contracted overnight. I guess it depends on the number, right? I'm a little concerned that it's going to be like yesterday, that the services PMI is going to come out exactly at target or maybe slightly above, and the market kind of just goes, oh, okay, I guess that means that nothing's really going to happen. Yeah. So, but we only got a minute. We'll see, right? It's a little weird that they're moving. They're making what seems like significant moves to me just before. So I think that there probably are some people placing bets. Yeah, it's a very strong pull, isn't it? I bet you there probably were some guys placing bets there short. So that's another thing to keep in mind, is that if the number is bad, this could like rocket back up to the highs. I think somebody's going to make some money on this, but the person that makes money might be the person selling the options. Okay, well, they moved higher. 50. The number is 50 versus 51.7. Okay, you know what, though? I think that I was dead wrong about what I just said there, though, right? I was saying, well, I think some people are putting themselves short, and so if it is a bad number, this could just rocket out there. There was a spike, but it's honestly kind of mild. That was kind of mid. Uh-oh, I've got an autistic child in here. Oh, it's good. Good job. You have clothes on. How did you put those clothes on yourself? Huh? Can you? Oh, you guys can't see him. Or did Mom do that? You know what I think just happened there? As he came in, he saw that I had all of the trading stuff up and was like, well, there's no way we're going to play Minecraft if he's trading. And then he left. Having an autistic son is something else, guys. There's rough things about it. It definitely like destroys your life in many ways, but there's other things that are really interesting and entertaining, and it's a privilege in some respects too. All right, guys. Well, I should get going, so I think I still have to make myself a lunch. So I don't know. We came back to unchanged, but maybe they'll make a move off of this. Maybe they'll maybe they'll start buying it up, and by the end of this session, we'll be back up at like 113 evens. I guess we'll see. So, you guys have a good weekend. I'll see you next week. In the meantime, stay excellent.